All right, guys. Good morning. David Bentinck here, coming at you here with another video. And today I'm bringing on Senior Mortgage Loan Officer Michael DeBacker, my preferred lender. Good morning, Michael. Man, what's going on?
Hey, buddy. How you doing?
Hey, I'm blessed, man. It's Friday. Thank God it's Friday, right? The grind includes Friday.
It does, and Saturday and Sunday too.
That's true. That's true. No days off. But hey, man. Hey, I want to bring you on. We're going to be talking about interest rates. We're going to be talking about programs, first-time home buyer programs, and what the market is really looking at right now. Just kind of educate my audience, get your name out there, and just so we can have a really great video talking about what the market is looking like right now. By the way, guys, if you're watching this live, drop an L in the comments below, and if you're watching this on the replay, drop an R. We want to see where you guys are watching from, so be sure to comment your location as well. So Michael, man, as a senior mortgage loan officer, you're probably seeing, all sorts of things on your end, right? Some things that us agents don't see, on your guys' end, right? You guys are seeing a lot of stuff on the back end. What are you seeing right now in the market as far as like, mortgage applications, that sort of thing? What are you guys seeing?
Yeah, man. So, there's a misconception right now that, hey, things have slowed down or COVID-19 has affected the market. So we're going to kind of wait it out. We're going to make sure everything's good to go and just be cautious in proceeding. And I can understand that, but the statistics are in, and we are up as an industry 18% on mortgage purchase applications, not refinance applications, purchase applications from last year. And last year was one of the hottest markets we've ever had. So we're up 18% in applications. If you're sitting on the fence right now, it's going to be a tricky experience for you moving forward, because I can tell you, I feel as busy as I've ever felt. I know that there's many people right now that are interested in purchasing. And again, it's one of those situations where, just like when the stock market is hot, the longer you wait, the more expensive things are going to become for you for that one particular stock you've been eyeing. It's the same thing in the housing market. There was a lot of belief that our housing prices were going to tank, at least here in DFW. I can't speak for other markets, but here in DFW, that was the belief, and it's just not going to be realistic, in my opinion, anyway. And I'm not a real estate professional; I'm a mortgage professional. But if there's this much activity and this many people looking to get back into the market to purchase a home, that would lead you to believe, again, supply and demand, that there's quite a bit of demand and maybe not enough supply, which is going to force prices to come back up or continue to climb.
Okay, makes sense. So let's dive a little bit more deeper into that. Why do you think that applications, not just refinances, but mortgage applications, people purchasing, why do you think that's up 18% versus last year?
It could be various things. There was a period of time where people weren't buying homes because of COVID-19. So it could be kind of the dam building up and up and up, and all of a sudden the dam breaks, and here we are in June, which, as you know, David, I mean, summertime is when we are supposed to be our busiest in this industry. It's when our housing market is the hottest, right? The hotter the weather, the hotter the market, basically, in here in DFW. So it was probably a culmination of that, of the dam breaking and people wanting to get out of their house. And probably, honestly, when you're cooped up in your house for 3 or 4 months, you probably start looking around, realizing how much you hate a lot of the things in your home, and you want things done differently. So you're going to go look for those things, and you got a lot of extra time to search homes on websites and whatnot. But you combine that with how low interest rates are. Right now, someone can go get an extremely historically low interest rate that allows them to get either a cheaper payment for the same priced home they were looking at, say, 6 months ago, or they can take the same payment that they were looking at 6 months ago and maybe get $20,000 more house, which is a big deal. That could be another bedroom. That could be, different amenities that they want in the home, et cetera. So I would really attribute it to those two main factors right now as to why all of a sudden we are just kind of 0 to 60 in this.
Yeah, no, it makes complete sense. And just to kind of, go off of that, there's a lot of people who are saying, well, with will come down, right? So in your experience, is it better to wait to see if prices will come down, or is it better to take advantage of lower interest rates right now so that they'll be paying less in the future?
Yes, can you kind of
elaborate on that?
Yeah, it's a great question. And timing the market is a very tough thing to do. If you talk to an actual financial advisor, and let's say you have an IRA portfolio, especially when COVID hit, a lot of people were saying, okay, let's take the money out and then let's put it back in at the right time. And doing that is a dangerous thing. And it's very similar to the housing market as well in mortgage interest rates. We are, again, at historically low rates. If it is going to hold true that our mortgage applications are going to continue to climb or stay at this rapid pace that we're at, that would lead you to believe our values, again, are going to go up. So if you sit on the sideline there, you may miss that boat. Also, too, again, with the interest rates, there is really not data in the market right now that supports why rates are this low. And what I mean by that is we as lenders, we can really follow the trends of interest rates based on how the stock market is doing, based on how mortgage-backed securities are doing, and the treasuries are doing. Mm-hmm. And oftentimes when stocks are doing well, that means that bonds are not doing well, which our interest rates are often tied to the 10-year yield. So if the bonds are doing poorly, that means the price of the bonds are going down, which means the yield goes up, means interest rates go up. That's an in-depth look, but really right. The summary of that is saying, if you look at how good stocks have rebounded, and last time I checked now, Dow's up almost 1,000 points today, which is historical and monumental. Well, that should normally, in a normal non-COVID-19 market, that would send our rates through the roof. We would see a huge increase today, but we're not. And the only reason why that is, in my opinion, is because it's an artificial, the Fed is artificially keeping our mortgage interest rates low by continuously to put money into the market. They are continuously buying mortgage-backed securities and bonds and things like that. So that will eventually go away. Once the Fed realizes that, hey, we're probably in the clear now, everything is optimistic looking in our economy, we've recovered, and honestly, we added 2.5 million jobs. We were expected to have a job loss report of over 7 million, but we added 2.5 million. That's monumental, and that's an indication that things are improving. So when the Fed agrees with that, they're going to stop putting money in the market. At that point, we're going to see interest rates come up, and I think they're going to come up fast because, again, there's just no data right now that really supports them being this low, in my opinion.
Gotcha. Now, as far as interest rates, what are you seeing right now in the market? Like, is there a specific type of range you can let us know what you're seeing?
Yeah, it's hard, Dave. It's hard to answer that question a lot of times just because every single scenario is different.
Sure.
You can look at average interest rates online, and even those really are kind of a farce, in my opinion, because I come from the background of lowest rate is not best rate. Lowest rate is just simply lowest rate. You may have had to pay an arm and a leg to get that. So I'm always looking at the best strategy for my clients, understanding what their short-term and long-term goals are. But then I'm also looking at 3 or 4 different interest rates based on those goals and comparing and contrasting those situations to see what fits them the best. Long story short, though, and this is by no means any kind of rate quote, but all day people are getting in the 3s right now. It's up and down the 3s is very realistic, but at the same time, we have to understand what people want to accomplish, what their credit scores are, how much they're going to put down, or what kind of equity they already have in their home on a refinance. I mean, the list goes on, but still historically low nonetheless is what I can assure you.
Gotcha. So everything there's a lot of things that are subjective, right? Interest rates are subjective to a lot of things, is what you're saying.
Absolutely.
Okay.
Yeah.
So
no doubt.
A lot of that kind of goes into like what people's credit score is, how much they put down, that sort of thing. So let's dive into a little bit about credit scores and what is needed to purchase a home. So what's the minimal credit score that somebody can have in order to move forward on the purchase of a home or to apply for a mortgage?
Yeah, and this is one of those things that has changed through the COVID-19 situation here. So when we look at what we were doing before, a 580 credit score was very reasonable. We could do that on an FHA mortgage. Technically, we could even go down to a 500 credit score if a client had 10% down for an FHA loan. Investors right now have tightened up in terms of those lower credit score options. Some investors right now, in fact, many lenders are not lending under a 660, some 680. I've even heard 700 with certain banks. Mm-hmm. So we are not that conservative. We are still at a 620 as the minimum credit score. I guess technically I do have a 600 option, but we really want to see you come in at that 620 to give you what you would deem to be desirable pricing. So yeah, 620 is going to be your barometer right now.
Okay, gotcha. And so what do you think ideally is, I have a lot of people I'm talking to who do have that 620, maybe 640, and do have that 620, 640 credit score, but they want to, get their credit score up to get the best interest rate. So what do you think would be the ideal credit score to get the best rate possible?
Well, if I'm literally going to look at top credit score, 740 is going to put you in that top tier from an interest rate standpoint, basically for about every 20 points on the scale. So 620, 640, 660, so on and so forth. You're hitting new tiers of pricing. And it's not so much that the interest rate changes. It could just simply be that the cost to get the desired interest rate changes, goes up or down or what have you. So a 740, that's going to be your top tier from a rate and cost standpoint. There are some additional tiers if somebody has to take a loan with PMI, private mortgage insurance. 760, 780 do affect those things. But really, if you told me you had a 740 credit score, we'd have no issues with you at all.
Gotcha. And what is a PMI, just for the audience's references?
Yep. So to keep it as simple as possible, anytime you put down less than 20% on a mortgage, you have this extra insurance you have to pay. Everybody knows you have to have homeowners insurance, which protects the home in case of disasters. But this is mortgage insurance. This protects the investor in case the borrower defaults on the mortgage. They go into foreclosure. They don't pay their note. It's an insurance for the company. And the reason why that is Fannie Mae and Freddie Mac, just over the decades of mortgages, they have deemed that anybody who puts less than 20% down technically is a higher risk of default. So they try to mitigate that risk by slapping this extra insurance on the borrower's side of the payment.
Gotcha. So somebody would have to put 20% down on the loan in order to get rid of PMI, correct?
The simplest answer there is yes. The more advanced answer is there are strategic ways where we can eliminate the PMI, but that's just another conversation for another day, really.
Gotcha. Understood. So, a lot of people who I talk to as well, especially with my age, they're renting, they want to get first time buying a home, right? They're ready to purchase, they're ready to get out of the rat race, and they want to start building equity. So let's talk programs. So has COVID-19 and everything that's happened affected, programs that are available, such as down payment assistance programs and first time home buyer programs?
No, not from the down payment assistance standpoint. A lot of other kind of outside the box programs, like a bank statement loan, where instead of sending normal documents like pay stubs and W-2s, somebody is just qualifying based on the deposits on their bank statements. Stuff like that has really started to go away. Some other products similar in that line of financing have gone away, but down payment assistance we're absolutely still doing. There are some additional restrictions, I suppose, that are in place there. Depending on where your credit score is, maybe you can't qualify for as much as you previously did. But outside of that, we're still doing them, and we do them frequently and often. And it's a good opportunity if you don't have enough saved for down payment, that it will at least get you in the house. Now, sure, if you have no money, you do have to save something, but it will at least cover the down payment, and then we still have to factor in closing costs and things like that need to be accounted for.
Gotcha, understood. So, and who qualifies for, let's say, let's dive into deeper a little bit about the down payment assistance program. Who qualifies?
Well, honestly, it's not even just for first-time home buyers. It's really anybody who's looking at buying a primary residence that needs help from an asset standpoint, meaning they just need cash to help close the loan. Right. There are some important things. It has to be a primary residence. You can't go buy a rental with this, of course. Minimum credit score 620, which is, again, not far from the standard. It's not that difficult to qualify for, and it's not so outside the box that it's a small group of people. Many people can utilize this.
Okay, gotcha. So what about first-time homebuyer programs? What are the qualifications on that as well?
Well, I mean, to be honest, we would really just look at the down payment assistance options for them. There used to be different benefits for first-time home buyers in terms of tax credits, for instance, which is all tax return related. There are some city grants and things like that, but honestly, those specifically are a little obsolete these days just because the income caps, you can make too much money to qualify for those programs. And so those city and county ones, again, it's been a long time since I've looked at them just because they haven't been really eligible for our market. I remember them being at about 40,000, 50,000 income cap. Well, it's hard to buy a house in DFW in the main cities that those are being offered. For instance, Dallas has one, the city of Dallas. Well, trying to buy a home in the city of Dallas, if you make 45,000, it's going to be difficult right now. And you're the expert there, David. I would let you respond on that. But the point is I don't really separate first-time home buyers and down payment assistance. If you are a first-time home buyer who needs assistance, we are going the down payment assistance route. That's what we're going to do. Gotcha. It just doesn't. You don't have to be a first-time home buyer to use it.
Gotcha. Understood. Okay. Gotcha. And so what are you seeing as far as the future? Like what do you think is going to happen with the rates? What do you think is going to happen with the future as far as mortgage applications, that sort of thing?
It's a great question. I didn't bring my crystal ball today, but at the end of the day, our market will stay hot for a while, in my opinion. Because the only reason why we had any sort of delay was COVID-19 related. Sure. But it seems that people are going back to work. We still have companies here. And again, I'm speaking on DFW. If you're watching this video, you're outside DFW, please keep that in mind that it's just different. I do lending in all sorts and all over Texas. But again, I only have a direct feel for this market. But we have a lot of companies, a lot of corporations that are moving here. They're putting their headquarters here in DFW, which is leading a lot of people to continuously move into this North Dallas area specifically, but a lot of the surrounding cities as well. So I do still envision that we're not going to see a decline in our market. Now, what usually happens is if the rates do come up and they come up quickly, there's usually a pause that happens. And in that pause, people are feeling it out and they're letting things kind of reset a little bit and see where we're at, and then they'll jump. It's just a psychological thing that happens. Whether it's the correct thing to do or not, it's just kind of what happens. It scares people off. So what I'm really saying is I don't expect any major declines. In fact, I expect us to continue on very strong with maybe a pause or two in there if and when rates start to come up.
Gotcha. Understood. Well, good deal. By the way, guys, if you're watching this live, drop an L. If you're watching on the replay, drop a R below and let us know where you're watching from. Mike, man, I appreciate you coming on here and dropping some knowledge, man. Is there anything else that you can tell us, or if people want to get a hold of you and talk about possibly looking to purchase a home, where can they find you? Yeah,
so I'm at The Mortgage Mike on Facebook. You guys can call or text my cell 214-718-2248. Guys, I'm here to help. And one thing I encourage anyone who's on the fence of buying a home, but just feels that, hey, maybe they're not ready or they're just not certain, apprehensive about the process, just have a conversation with me. It doesn't cost you anything but a little bit of time. You can really gauge, okay, this is a reality for you, or hey, here's what you need to work on. There's nothing wrong with that. But the longer you wait, the longer you sit on the fence, the longer it is before you make that decision to explore these types of things. And truth be told, again, if you need a little bit of work, whether it be credit or assets or just maybe a cosigner, whatever it is, it's better to find that out now than wait 6 months to have the conversation and then start that rebuilding phase, if you will. So I encourage anyone listening, feel free to reach out. Let me know what I can do to help you out.
Right. Okay. So what you're saying is, let's say somebody was wanting to buy in August, you would recommend them to start having at least a conversation with you now. Correct?
If they have any doubts about where their finances are, absolutely. That's what needs to happen now, because if you're looking at buying, let's say your lease is up in August and you need to be in a home by that time, and you wait till July to have that conversation with me, it might be too late. I may not have enough time to spend with you to get you where you need to be, and then you may have to rent for another year and miss out on the great interest rates. So again, we can have a very general phone call, 5-10 minutes, understanding kind of what you're bringing to the table, and I can give you my 2 cents on that. So Don't let anything discourage you. Have the conversation if this is in the near future for you and your family.
Gotcha. Understood. Well, guys, that's pretty much it. If you have any other questions about the lending process, feel free to reach out to Michael. If you're looking to buy or sell real estate here in the Dallas-Fort Worth area, please give me a call, 214-384-1630. That's about it. If you have any more questions, feel free to reach out to us. Again, we're here to help you guys. Mike, anything else, man?
That's it, brother. I appreciate you having me.
Hey, man, I appreciate you coming in and drop us some knowledge, man. Feel free to bring your crystal ball next time.
I'll make sure to do that.
Gotcha, man. All right, take care.
See you, buddy.